All right, let's just jump right in. Welcome to this explainer. Today, we're pulling back the curtain on the high-stakes world of institutional trading over on India's national stock exchange. We're going to look at exactly how massive, market-moving trades are executed behind the scenes. If you've ever watched the ticker and suddenly seen millions of shares change hands without completely blowing up the index, well, you've probably just witnessed a block deal. But how does that actually happen? Let's figure it out. Before we even get into the mechanics of this, we need to establish the stakes. And the absolute minimum to even enter this arena, 10 crore rupees. That is the baseline for a single transaction to even qualify for this special mechanism. So we're definitely not talking about your everyday retail trading here. This is strictly the playground for institutional investors, mutual funds, and ultra-high net worth individuals moving serious capital. So here's our roadmap for today. We'll start with what exactly is a block deal, then timing the trading windows. Next, pricing and order matching. After that, the strict rulebook. And finally, settlement and market impact. All right, moving to part one. What is a block deal? The high-stakes arena. The exact definition here is absolutely crucial. A block deal is a single transaction of a value greater than 10 crore rupees, executed directly between two specific parties. Notice the emphasis there. It's not just a giant order you sprinkle into the open market hoping for hundreds of tiny retail fills. No, it's a highly targeted handshake. It deliberately bypasses the normal market noise to prevent massive price volatility. And to actually pull this off on the trader's terminal, you need specific tagging. The exchange dictates that block deal orders must be entered with BL as the series. The book type has to be tagged OL, and the market as odd lot or O. If you forget those tags, well, your 10 crore order entirely misses the dedicated block session. It's that precise. Which brings us to part two, timing the trading windows, the 15-minute clock. You can't just execute these mammoth trades whenever you feel like it. You get exactly two 15-minute windows during the entire trading day. That's literally it, 30 total minutes. First, there's the morning block deal window, which is a quick sprint from 8:45 a.m. to 9 a.m. IST, right before the normal market opens. And then there's the afternoon window, slotted exactly from 2:05 p.m. to 2:20 p.m. IST. These incredibly narrow windows are there to ensure liquidity is concentrated and that the regular market doesn't get abruptly shocked by these whale-sized moves. So what actually happens if those 15 minutes are up and your trade hasn't found a match? Well, the NSE is completely ruthless here. Unmatched orders are purged instantly. If that clock runs out without a match, your order doesn't linger in the book, it doesn't carry over to the next session, it's just immediately canceled and wiped from the system entirely. You're starting all over again. Okay, part three, pricing and order matching. Absolute exactness required. When you're in that window, you are locked into a microscopic price band. Your order must be placed within exactly plus or minus 1% of the applicable reference price. You can't just negotiate a steep discount or pay a huge premium just because you're trading a massive block. The exchange enforces this strict 1% band to make sure the block deal accurately reflects the true market value of the security. It essentially prevents price manipulation. But how exactly do they determine that reference price? Well, it's a very strict step-by-step fallback process. First, the system looks at the VWAP, that's the volume-weighted average price between 1:45 p.m. and 2 p.m. If no trades happen during that time, it falls back to the morning session's VWAP from 9 a.m. to 1:45 p.m. And if there are still no trades, it defaults to the previous day's adjusted close, or base price. It's a completely rigid checklist with zero ambiguity. And the matching engine itself demands absolute symmetry. Look at case one here. A 100,000 quantity buy order perfectly matches a 100,000 quantity sell order at the exact same price. Boom, done, trade executed. But look at case two. The system is completely unforgiving. A massive 100,000 buy order will straight up ignore two separate 50,000 sell orders, even if the price is identical. If the exact total quantities don't align perfectly between those two specific parties, the engine just will not pair them. It is an all-or-nothing game. Moving on to part four, the strict rulebook, what you cannot do. Because we're dealing with massive amounts of capital instantly, the rules take away a lot of the standard tools everyday traders are used to. You can't use market orders, only limit orders are allowed here. There are absolutely no partial trades, as we just saw. It's all or nothing. You can't use special instructions like stop losses or disclosed quantity. And maybe most importantly, there is absolutely no reversing or squaring off the trade in the same session. Once the trade is done, it is completely final. Now, what if you make a mistake or you desperately need to tweak your bid during that incredibly stressful 15-minute window? The system only lets you modify 3 specific things: the rate, the quantity, or the client code. But here is the massive catch. If you modify the quantity or the price, the system actually re-times your order. And since matching is built entirely on time priority, modifying your order basically sends you straight to the very back of the line.
There's also an ultimate kill switch. If the broader market experiences extreme volatility and hits an index-based market-wide circuit breaker during your block deal timeframe, the block deal session simply isn't conducted. All of those carefully constructed 10 crore plus pending orders, they instantly vanish. The exchange will always prioritize overall market stability above everything else.
Finally, Part 5, Settlement and Market Impact. The aftermath of a massive trade. So you've successfully navigated the 15-minute window, matched your exact price and quantity, and survived the rules. Now what? Well, the block deal settles rapidly. It operates on a standard T+1 settlement cycle, exactly like the normal market. That means the exchange of shares and cash happens on the very next trading day. It gets the exact same settlement guarantees as the normal market, and remember, every single trade executed here must result in actual delivery. There's no intraday speculation allowed. But here's where the wider market finds out what you did, because you really can't hide a whale. The NSC publicly broadcasts the details of these block deals to the general public on the very same day, right after market hours. They officially disclose the name of the script, the exact client names, the quantities bought and sold, and the traded price. Total transparency. And all of that massive volume is officially added to the total market traded quantity and turnover for the day. So, when you consider the absolute surgical precision required, the stressful 15-minute ticking clock, the microscopic price bands, and the totally unforgiving rules against partial fills, it really changes how you look at market volume, doesn't it? Next time you see a massive spike on the ticker that somehow doesn't crash the index, you'll know exactly the gauntlet that order just ran. So I'll leave you with this. If you had 10 crore rupees on the line right now, could you execute the perfect block deal? Thanks for tuning into this explainer, and keep an eye out for those whales out there.